all. So I'm here to teach you about financial modeling. And what I like to do with these workshops is make it super interactive. So anytime you have a question, please stop me. I'm happy to answer it because I find that in-time questions are the best so that we can address any thing that's not clear or anything that's on your mind. And most of the time, everyone tends to benefit from what you're asking about. So let's, just take the workshop where it goes. And I just have a few slides to kind of help us stay on track. But other than that, I would like to be very hands-on. And I even have an example spreadsheet we can jump into to make sure we can do some modeling together so that it really sticks as far as the content goes. So I'll just do a quick intro by myself. Like Carrie said already, I'm a finance manager at Intel. I've been there for about over 8 years. I supported several businesses, including software, hardware, and supply chain. I'm currently in sales and marketing. So I got a plethora of background in different areas, but definitely my specialty around software as a service. So SaaS companies that I currently work with or that I've supported in the past, also from an entrepreneur side. And I do a lot of consulting. I love doing the planning and strategic side of finance, which is the future looking and making sure you have information to make better decisions. And I also have some background in operations management. So just overall well-rounded. So I'm happy to answer any questions in any of those areas that you might have concerns on as far as your company goes. So we're just going to deep dive right into it. I have just a pretty basic P&L walkthrough. I want to make sure we're all on the same page and at the same level of understanding of what those components are. We're going to talk about how do we create a financial model, what are the components of a good financial model, and then how do you keep that up to date to make sure you have clarity as you move forward in your path towards financial results. And like I said, Q&A is fine throughout it all. So a P&L, a profit and loss statement or income statement, as some people like to call it, that is more the official name, P&L for short. It just summarizes your revenue, costs, and expenses during a specific point in time. Normally, we're looking at this monthly, quarterly, yearly is pretty normal for our businesses. As a business owner, you definitely should be looking at it monthly at least, so that you can better manage the ins and outs of your business and make sure you have control over what's happening, and also give you some idea of what the areas of focus should be for you to address as you see money coming into the business and going out. So we're going to stop at the top line, which is normally referred to as income, sales, or revenue. They're all the same terms. They refer to the same thing. And following that, you have cost of goods sold if you're a company that's selling product. If you're a SaaS company, there might be some development costs attached to this to get started that you want to consider. Otherwise, you can subtract that from your sales or revenue to get to your gross margin. And then overhead will be the next piece of what makes your company function. So you have salaries, or you have your rent, or any utility bills, any software subscriptions that you use to operate your businesses. Those are operating expenses that are going to be in that bucket, and tend to be very controllable sometimes, not always, depending on what type of business you have. And once you subtract that from your gross margin, you'll have your net profit or loss sometimes, which is possible as well if you're spending more than you're making. And those are the components of a profit and loss statement that I want to make sure you guys are focused on tracking over time to see how the performance of your business or the health of your business is coming along. Now, what the P&L is going to do is give you a baseline. I know that some of your pre-revenue that might not have as much information when it comes to that, setting that baseline based on historical. So we'll talk about what you do when you forecast from that place. But some of you who are already generating revenue should have all these components outlined. And if you don't have an accounting system that's doing this for you, you should be tracking it on a spreadsheet at the very minimum. And like I said, reviewing it monthly. But you should be bucketing these components correctly. So ideally, you're using some kind of software to help you track and optimize your time. So you can just pull a report that says profit and loss, and then you have all this information at your fingertips by month. Are there any questions on that? That's pretty basic, just kind of setting the tone before we move into a little bit more complex forecasting. Okay, I think you guys are all on the same page with me. Great, moving along to some methods for creating financial modeling. So what I always say about forecasting is that this is just an estimation or a prediction that you're trying to put together based on some basic knowledge you might have about either your industry, your company, or historical data that you've gathered. And in that historical data, when it comes to revenue or sales, you're going to have a certain number of customers or a number of units of something you're trying to sell along with a price. And that's how you're going to come up with what is your sales goals or revenue goals, which is also in turn forecasting for the future, what you want to accomplish in your business. Why that is important is because it's really guiding what is the mark, what is the amount that you would like to generate in your business, which then will help you actually set a budget long term. When we talk about forecasting, we can talk about different time periods. It could be you forecast out a week, you forecast out a month, a quarter, or a year even. And some companies even go out to 5 years, which brings a lot more uncertainty into the model, but it can be done based on some high level assumptions. We're probably going to stick to no more than a year for this conversation, just to keep it a little bit more tangible. But as your business grows, just keep that in mind, since that is an exercise you most likely will have to go through every year as you're setting some new goals for the company. The same thing applies to your costs. Your overall cost of goods sold or your fixed and variable costs are going to come into play when you're trying to define what is the profitability target you're trying to hit for the company. Now, you're going to set this ahead of actually taking action and achieving those goals. So you need to be realistic. You need to think about what other competitors might have done in your industry. You can look at some big companies for some data sets to help guide your forecasting. That might not be true at first, but you can try to hit those some benchmarks that you utilize to figure out what are some of those costs that you were expect to incur. And sometimes we'll look at that as a percentage of revenue, so that way we can better manage as revenue grows, our expenses can also grow along with it, and make sure that your profitability profile continues to stay at a certain level. Now, the reason I bring that up, because forecasting is going to help you better plan your resources for the type of results you're trying to achieve in your company. It kind of helps set that standard that you're going to measure yourself against and help you evaluate along the way as you're accomplishing certain milestones on growing your company, hopefully upwards in revenue and upwards in profit. And if you're not profitable at first, that's okay, because we're going to plan to be profitable. We don't have to be, profitable day one. Sometimes we have to invest upfront some cash to develop product or hire people to help us make that money. But the goal would be to have a plan so that in the future you can get to that profitability and it doesn't take longer than you expect and you run out of money. That's why cash planning is super important in this scenario as well. Now, I do like to think about the assumptions that we use to create a financial model, and not only think about them, but really write them down. It's really important that if you're planning today, you're going to be in this state of mind thinking, oh, I can get 20 customers in 5 days and they're going to pay me this much money. And you think that's totally realistic. And then a month later, you're going to come back and look at that and say, oh, what was I thinking? Maybe I only got 10 customers. I have the price I thought I would. So I'm going to change my assumptions going forward, but I can measure against what I thought was real. Or maybe you blew that out of the park and you got 100 customers that are paying you triple what you expected. So now you can set a new realistic bar going forward to better plan what your sales are going to be and what that profit at the end of the day is going to end up being. And so that's why it's crucial we write down our assumptions. And what I like to do also is set up some type of range, so that way you're not only working with absolute numbers, though you can just do one scenario and go with it and run with it. That way you're not spending a ton of time here. But if you feel like you have a low end and a high end of your forecast that you potentially could hit, it gives you some flexibility to work within those boundaries so that you can make the results happen. And on the low end, it'll be a smaller amount that you're going to hit. And once you hit that, you can go for your stretch goal, which is the high end. And so I find that that is helpful so that you know where you stand at all times. And then maybe a middle range could, come into play where you're like, okay, I can break even at the middle range. So we're going to go for that. And then on the high end, I'm going to make a 20% profit. So we're going to push for it this month. But having that notion of what are the components that generate the revenue, like I said, the customers, the units, the price, are really going to help you set the standards to that realistic number that you're trying to achieve month to month. And again, it's not going to be perfect the first time around. It's going to take some trial and error, but you're going to definitely get better at it every time you go through this process, because you'll have yet another piece of information to rely on and to be able to fall back on. And that's where the historical data and is really going to come in handy to predict your future trends as you're working through it and coming to revisit your model every so often. The cadence is really up to you to determine. It really has to have some significant change for you to want to come revisit it more often than not. And we'll talk about that in the refresher part, but it's definitely an exercise that I feel is valuable if you have, enough changes happening. To modify your future trends. Okay, I just threw a lot at you guys. So what questions do you guys have?
I have a question about the operating costs on the operating expenses on the previous slide. So we're running a product now, but when we were running a consulting company, it always used to irritate me that all the salaries were considered operating expenses and not cost of goods sold. Can you talk a little bit about that rationale, why it's always in operating expenses, and is that a good thing or not?
So it's not a good or bad thing, honestly, because it is something you can control. At the end of the day, you can, even though it might not feel like it, you can decide whether or not you want to keep all those people, if those people are generating a certain amount of revenue, are they paying for themselves? And if it falls in cost of goods sold, it's just going to reflect in your gross margin versus your net profit. So it's just where it gets bucketed. At the end of the day, it's still going to flow through your P&L to give you the same profitability profile. So it doesn't really matter where the cost is going to hit as long as you're capturing it. And then are those people really generating, the sales that you're expecting, especially when consulting, which is directly tied to a person delivering. It's going to be something that you can control. So if you say, hey, I'm going to, for example, right, you're going to double the work of everyone and you're going to cut the staff in half, that is totally under your control to do. And then generate more profit that way. Obviously, there's other implications with having to make that kind of decision, but it is something controllable. So, you could still play with it in a way that you still have to take care of your employees and make sure that you're compassionate and empathetic about, having to let people go. That's why I always advise people to grow cautiously and not too fast, because then they don't have to have those conversations on, do I need to keep the staff? Do I need to lay people off? And how does that cost and goals align to the overhead I'm bringing into the company?
So it sounds like you're implying that operating expenses are things you generally control, like all your overhead.
Yeah, because the cost of goods sold is the cost of making something that you can sell. So it's a little bit less in your control unless you can negotiate pricing or quantity, to get some discounts. That's a little bit less that you can influence, where the operating expense, you really can choose to spend nothing, but you also might not generate any money. So you just have to know the relationship between the two.
Caught it. Thank you.
Yeah, of course. Okay, everybody's so quiet. I hope you're finding this level of detail helpful. And like I said, we'll circle back with an example to help digest some of that. Okay, so let's talk about some of the components that I like to consider when creating a financial model. You definitely want to start with having a certain level of detail, no less than a P&L structure, because we need to be able to know what's in that. Within that P&L structure, like we just mentioned, some of the costs are going to be payroll, maybe rent, utilities, subscriptions, whatever it is that you utilize them to generate revenue in your business. And you need to be able to track that. And that's why accounting software really comes in handy, so you don't have to do all that work yourself. Now, you definitely can get in the weeds and start generating new general ledger accounts to try to track every single detail of what goes in and out of your business from an expense perspective or even a revenue stream. And I always caution that you want to make sure you're measuring things that matter in your business, things that you can make decisions on. For example, if you have a company that has 4 different revenue streams, and they're doing some consulting, and then doing some software subscription services, and they're doing some partnerships that maybe are more break-even type or less profitable, and then you want to track maybe payments of some kind of royalties that that someone owes to you. Those will be the type of revenue streams I would want to track, because they behave differently and they have a different profitability profile, and I would want to measure that to make sure I understand what what is performing at what level. When you combine that into one line and you just say revenue, that's fine too, but now you don't know where your revenue is derived from, because you haven't gone the next level, the next click down, to see which revenue stream is healthy, which one needs some work, which one do you want to double, which one do you want to cut out completely. And so it's important that you think about that structure as you're setting up your general ledger to track not just revenue, but also expenses. And at what level do you need to track those to make decisions? For example, on payroll, you're going to have maybe benefits, you're going to have the salaries, you're going to have processing fees for supporting the payroll every time you run it. And you might want to track those 3 separately. If you don't, then it'll just be payroll, and you will just be wondering why payroll is so expensive in your company when you haven't broken down those components within that. So track what you want to make decisions on and things that you want to measure, so that you can have more clarity on what's going on with your business. And that's what I mean by having enough detail, but not too much.
Carla?
And yes.
Oh, I'm sorry for interrupting.
No, please go ahead.
I was just thinking, because my staffing company operates in tiers. We have 3 tiers. The first tier is someone who is new to our industry, and the third tier is someone who, like me, can run a portfolio on their own.
Yeah.
When we're talking about the health of our revenue streams, would it then be a good idea to differentiate those tiers so that I can see which people are selling the best?
Yeah, I would imagine that by doing it by tier, you would have people who are running the portfolios be maybe bringing in more profitable lines of sales or revenue than the people that are just starting out. And so I would want to track performance on those different tiers, so that I can gain clarity onto, if I hire 2 more people to do tier, the highest tier, I know what my return on investment will be on that. And then similarly, you probably want to track on the expense side something equal to where you're tracking salaries of each of the tiers. So you can say cost to revenue return, and you can see the correlation between the 2. Now, that's just one way of cutting the data. You could also look at it by time in role, maybe. Like, you want to track people that have only been in the company for the first year, like people that are coming and going, maybe more turnover, and then people who are longer term. Maybe you want to look at it. I'm trying to think, in your real estate or property manager, maybe it's managers with inspection background, or managers who own properties themselves, and you want to track the revenue streams of people who are different that way. So it's just up to you what's important. Also, the type of revenue stream it is it coming from managing properties, or is it coming from managing a portfolio of investments? What is driving that revenue to be generated would be another way of looking at the data and really analyzing how you're earning those dollars into the company.
Got it. Thank you.
And I'm trying to think on the spot of examples, but you get the gist.
Those are great examples. I think the vocabulary of it was different, but if I could track which like, is it a maintenance technician that I'm hiring for, or a property manager, or is it someone with HUD experience versus tax credit experience?
You got it. Yeah, exactly.
Okay. Thank you.
Yeah. Yeah, it just all goes back onto what are you seeking to have clarity on, and that you can make decisions on. That's really the 2 main drivers on how I want to look at the data for any companies that I'm supporting financially. So I'm going to go to the next one, and this one is focused on margin and profit. And what I find with most people is that sometimes they're not even aware of what their margins are on their products or sales type services. And they might be breaking even, they might be losing money. And it's really important as a business owner for you to know, what are those margins? Are they healthy? How do we increase them over time? How do we reduce expense to generate more margin for the company in each of the service or revenue streams that you are accounting for? And that's why that's important in the first place. And then at the end of the day, what is the profit that's left over? I don't care if you're $1 million company, if you're losing money, it doesn't matter, because $100,000 company that's making 80,000 in profit is a way better than $1 million company. So it's really thinking about, what is the bottom line? Is there enough money there? Is the money just being reinvested, which is okay too, as you're trying to grow the company, but it's really putting the focus on not just the top line, but also what is left behind at the end of the day. And can you show profitability? Because I see a lot of clients that are not showing profit because either they're paying themselves too much, or they have too much staff, they have a ton of overhead. And then when they go apply for loans, nobody's approving them because they haven't shown profit for the last 2-3 years. They can't get financing. They got not enough assets for them to get approved. And so then it becomes a problem for growth on how do they get the cash influx besides going to investors for capital. So it's just something to consider as you're working through your P&L scenarios and really thinking about profit, because we want to make sure we get to that point where we're showing profit. And if it's not happening now, what is the plan to get to profitability? And then setting some targets to that will be helpful as well. So that way, you know how to achieve them over time. Now, the next component of a good financial model is to keep it flexible and adjusted as you get more information. Models are not going to be stagnant. They're going to be, again, that standard that you're setting, and then you're going to come back, revisit at a certain point in time and adjust for it. Now, what I like to do is when I'm modeling is I'm leaving variables available for me to adjust later. So for example, if I'm expecting a 5% profit for the company this year, but then I want to make that 15% to see what happens, what needs to happen from a sales perspective and a cost perspective to achieve that, I can easily change that variable and then the model can update. And that's just a way of modeling your financial spreadsheet. So that way, when you make adjustments, they're super easy and you're thinking ahead on how to make it more user-friendly. So you don't have to rebuild your model from scratch every time you want to change one variable. So that's super important. And we'll look at a little bit more in the spreadsheet example I have, but it's really just using formulas and inputs so that you can easily see what happens when you change something. Now, I love to utilize scenario planning. Scenario planning is going to be essentially your low, mid, and high that I talked about. There's this range of possibilities, and you want to know what happens if, and then you insert a question that you have. What happens if I hire 10 people? What does that mean for my business? Am I going to be profitable? Can I afford it? If so, when? And so having the scenario planning is really going to give you that clarity to see what happens when you change a variable. And so having that outline is going to help you answer some of those questions ahead of you making that decision, so you can then have the information and the data to make a more informed decision as you go along. So it's important that you think about that scenario planning as a tool in your back pocket to pick from, to kind of work through before you go take action, and then it's harder to undo whatever damage or maybe good that you intentional or unintentionally intended to do in your business. Now, I don't know about you, but I love to ask a lot of questions. My clients pay me a ton of money to question the crap out of their models because we want to make sure we have the best information available. And if it's a question that we don't have an answer to, that's okay too. We've asked a question, we thought about it, we have an idea of what we need clarity on, so we can then bring that piece of information into the model to make it smarter and make it work better for us. It could be a piece of benchmark that we're missing. It could be hey, what was this a year ago, or what would it be in a year if we added those 10 people. And it's just about thinking through what is missing in the model that you can add to it to make it more comprehensive, to make it better and more complete for you to utilize in your financial forecasting overall. That's where, and then any question is good to just write down and have and can revisit. And if it's not relevant right now, that's okay. You can just, put it to the side, but come back to it when the time comes to reassess that and make sure you have an answer for it. So those are the components that are really going to help your financial model be more robust and nimble as you're forecasting your finances in the company. Are there any? Yeah.
Do you recommend any specific tools for the scenario planning? Are you just supposed to use the same spreadsheets that you're using for your financial model in general, or are there specific tools that you would recommend for that?
Yeah, definitely. So I've played with a few. I'll start by saying that Excel is totally fine. You can make tabs in Excel and you can duplicate, copy, paste your model, and then change inputs and variables. And it can totally work for you. So you don't have to purchase any expensive software. Now, I've played with a few. I'm not in love with any of them because the problem with models that are built is there's a set of assumptions behind the scenes and I don't know what those are and I don't have control over them unless the software allows me to have control over them. And so that's where it becomes a little nebulous and I hesitate to use them if I don't know how to spitting out an answer and I can't answer all the questions my client might have about X variable. So I've played with LifePlan. I find that is a high level software tool that has helped models, especially for software as a service, Michelle, since you have a SaaS company. It does do recurring revenue. Again, I don't know all the assumptions that go into that. So I always get hesitant to use that, but you could definitely use it for a high level conversation and get connected to QuickBooks, super easy to bring in data. So that way you don't have to do everything by hand. I'm trying to think, I think Plan Guru is another tool. I haven't really played a ton with that, but I know they had some good functionality too that I was evaluating. But if I'm being honest, I really just stuck with Excel because of what I just mentioned, which is I have full control of what goes into it. So I can really explain and walk through what the tool is saying and the story around the data that I want to make sure my client understands before they go off and make $1 million decisions.
Great, that's really helpful.
Yeah.
I think I have about 8 tabs on my Excel spreadsheet right now
Yeah.
with different versions of things, and none of them are right, but at least I can play.
Close. Hopefully one of them is close and that can help you make better decisions. So that's really the goal of that forecast. So excellent. Let's continue to move on and please let me know if you guys have any questions. I'm going to switch to the spreadsheet here for a second because I want to show you guys some example. And I know you had a few questions, so I want to make sure I address those. And then I'm happy to send this out as an example too, if that helps. Carrie, I don't recall, I think I might or might not have the questions handy. I just don't want to, might be a good time to answer those now if you have them around. And if not, I can pull them on my email. I'll just have to pause for a sec. Oh, I think I have them on my phone. Hold on. So make sure your questions.
I've got them here.
Okay, perfect.
So one is in how to pull ratios from the P&L.
Yes.
And another is seeking help with realistic year one forecasting and financial modeling.
Yeah, let's talk about that. I think that will be helpful application of the content we just viewed. So I'll address that now and then we can go from there. So I just did a quick example here of some data sets a company might have for 2018 through 2024. Like I mentioned, 5-year forecast is not unheard of. It's called a long range plan, or LRP for short. And this is something that I use very commonly with clients as they're thinking about their longer term growth strategy. And so what we have here is just the quick example I had around income or revenue or sales. What are the streams of income we're tracking for this example? I like to see some year-over-year growth metrics just to see how, income or sales are growing over time. That's just important to understand. The next piece being cost of goods sold, and then some gross margin derived from that. And also expense as a percent of revenue is a really good ratio to keep an eye on, because while you might be spending more money in your business, if it's generating more revenue, that's not a bad thing. So you want to keep track of that to see over time how that's behaving. And this is a yearly forecast, but we can also look at this monthly, which is something I would recommend you do as well to evaluate the health of your business over time. So I think I have an example of that next, so I can switch to that following this. So those are a few ratios. Let me kind of scroll down to the bottom. So I think I had operating gross margin and net profit margin at the bottom, so that you guys can see an example of how to track that. It's just pretty straightforward metrics, but it really tells me a lot about the health of the business over time and how things are behaving. And as we make decisions, how this gets impacted is going to be critical, especially as you start to invest more in your business to generate more sales, more growth quickly. That's going to become important for you to be aware of and track over time. And again, we talked about profitability, right? So this is where I would set some profit targets for a client to say, hey, we don't want to be less than 20% profit over time. When does that start? And when do we start generating that level of profitability? And can we maintain it over time? Because that's another critical point of financial forecasting. And you can see, we talked about the different levels of expenses that you would want to track. And so there's just, a few random categories. I think I have a few more to show you as an example of things that you could potentially be tracking in QuickBooks or on a spreadsheet or any accounting software you use, Xero, any of those that you choose to track your accounting on. And those are the categories we're going to start looking at, managing, and making decisions around. If you see your costs are going up in contractors, you start asking the questions, why is that? Is that generating more return on investment? Maybe not right now, maybe in a year, I'll see 2x return from that investment. So it's important for you to start asking those questions and really know what's in that, because it is something you can control after all. And so on and so forth for all of the categories you see here. So those are some of the ratios I like to see. Month over month growth or year over year growth is important for you to track. And then if you don't have historical data, a good first year forecast is going to include your initial investment. So if you had to put any money down or get any money from investors to start a company, make sure you're tracking that. You most likely won't have a ton on income. It's probably going to be mostly expenses unless you're selling right away and generating some profit or income, sorry. So you should be tracking that. And again, setting up what are those revenue streams. By the way, the revenue streams don't have to be stagnant either. They might change over time. You might choose to add a new revenue stream that you want to track. So for example, one of my clients started doing estate sales, and they used to just do home keeping and home organizing. So we're adding a estate sale revenue stream to track those expenses to make sure, and that income, to make sure we understand, is that profitable? How is it growing over time? How is it differently behave from the other two revenue streams we're already tracking? And so year over year, I like to evaluate that to see if I am looking at it the right way. You can change the way you look at it too. Like Alicia was talking about how, she might want to see the data in the income side. Maybe she doesn't like it that way for next year, so she's just going to change it. Just be careful how much change you do from year to year, because you do want to make sure you compare year to year and you have some solid figures to go along with that. So try not to go too crazy on that as you go through your business. But evaluating is important so that you know how things are behaving. And that is part of the first year forecast. Is going to be important to understand what is that baseline you're setting, what are the expectations that you're hoping to achieve in that first year. I would even want to break down the yearly forecast quarterly, probably set quarterly goals, and then adjust as you're ending one quarter, adjust them for the next, because you will have more information. So what you want to do is maybe you do want to forecast the whole year, but then you can revisit at least quarterly to see what's happening. And as you see the actuals come through on the financial, then you can better forecast your following quarter and make the changes necessary. And don't forget to write down your assumptions, because those are going to be key. Now, in this example, we talked about making your model kind of nimble so that you can make adjustments. So what I have here is the inputs tab. So when I'm modeling for a client, what I want to keep in mind is that my client might say 18% today, and tomorrow they mean 10%, or something changed in their business, and this percentage we thought of growth just drastically doubled, and we want to make sure we can easily model after that. So when we're talking about the future years, it should be as simple as punching in a new percentage, and then the model, the P&L should completely update. Now you can always revert back to what you already had, but by setting up this way with an inputs table and then making the formula reference that input that you're creating here, it's going to give you the nimble flexibility you need to be able to refresh your model often and not have to redo it from scratch every single time you change your mind about an input. It also helps you with scenario planning, because now you can change a variable and see how that flows through the model. Does that make it more profitable? How much more profitable? Or does that make me run at a loss? And that's something I need to consider as I'm working through it. And so I'll write my assumptions to the right here, and then I'll adjust any variables here that will flow through the model that you just saw. So I'm going to stop there for a second to see if there's any questions on that or anything we just covered. Okay. Okay, so the same thing applies to not just sales, but cost of goods sold and operating expense over time. The other thing I like to do is really break it down to a more detailed level where I really can tell what is happening in the company, especially in that first year forecast that the question got asked about. How do you create one, which we have no idea what is it going to be in the first place? I don't know about you guys, but most of my clients didn't plan for COVID, neither did I. And that was an expectation when we first put the forecast together for 2020. But what we did have was a baseline that we had set. Maybe for sales, January through June, we were certain that we could accomplish $100,000 in revenue in that first 6 months. And then we had to adjust it later for COVID impact during the Q2 review of the budget or forecast. And that's going to be important, because you'll need to make a note that you're revisiting this assumption and making sure that you adjust to the reality of what has happened. Obviously, we don't expect to have a COVID year every time, but there will always be something uncertain that happens that could derail your forecast. So it's important to understand, where did these numbers come from? What were my assumptions along the way? And so for this particular example around the wine company, that was super realistic for the first 6 months. And then what happens in July is that there's going to be maybe a renovation of the store, and they're going to have a grand opening eventually in September or sometime in Q4. And so it's important for us to break down by the month what we think revenue is going to be. And then we can tally it up to a total for the year, which then becomes much more realistic and much more attainable, because every month we have a goal that we're trying to seek to achieve as we're going through the year. Now, in some cases, we lump some months together because we weren't sure exactly how September and October were going to behave standalone from November and December, which is like the holiday month where this wine shop might sell more wine. So it's important for you to think, okay, if I don't know exactly, I'm going to use this range that we talked about, and we're going to range it by months. And we're just going to say, hey, September through December is our best time of year. So we're just going to exceed what we could do in the first 6 months of the year. And we feel that is realistic. So you start checking your gut on what you think can be done. And then not only what the goal is, but what is it going to take to achieve the goal? So have you thought about how many personnel do you need to have in the store to be able to sell that much wine? Have you thought about how much inventory do you need to purchase ahead of time? Do you know what are some of the costs on utilities that you're going to have to pay for in order to support this generation of revenue? And those are some of the questions I want you to start thinking about as you're modeling. You can model $1 million a year, but how are you going to get there? What is it going to take? What are some of those pieces that are going to help you achieve that? Maybe you have to hire a coach. Maybe you have to, train yourself in financial modeling in order to be able to understand that better. So those are kind of the costs I want you to start thinking about, and then write them down, because it's really easy to say, oh yeah, I know what it takes to do $100,000 in 1 year. And then you forget about 20 things that you didn't think about. And you should be adding that to your list as you go along the year. Now, we did talk a little bit about how we do a forecast. And if I even break it down to just like a month, you can see that there should be this offers or service or products that you're selling. And you can decide what those type of offers might be. They might be different. They might not just be one type of thing that you're selling, either service or product. But you do know how many clients or how many of it do you need to sell, and at what price point in order to achieve a certain revenue goal. And so this is where we break it down by just number of clients or number of products that you need to sell, or number of subscriptions that you need to have, what price point you're choosing to start at, and will that change over time? Maybe, you don't know, right? You might choose to raise prices over time. And what does that equate to the total revenue? You do that for each of your revenue streams to get to a total for the month. And now you have your monthly goal that's realistic, that's attainable. Now you can take steps towards creating this many touch points with clients to sell that offer at a certain price point to be able to achieve those goals. And then you know that if you didn't accomplish that you fell short and you need to make it up somewhere else. So this is really going to give you a good roadmap to now take action to make those numbers be real, and also the benchmark for next month, so that way you can adjust it based on maybe there's some seasonality in your business you haven't thought about yet because you don't know what that is. Maybe there's a seasonality in the industry that you're aware of that you should be accounting for. So that's another piece of the puzzle that you want to consider. Or maybe this is totally unrealistic and you don't know until you go try it. So it's important you can come back and revisit against these numbers and have an idea of how that all plays out. Now, the next thing I like to do, not just set a forecast, but also figure out how do you perform against your forecast? Because sometimes we forget about that. We're just like, woohoo, we made money. And then we're like, did we do better than we thought? Or did we do worse? Or we're on par and maybe we have some fluctuation, we're okay with it. So measuring against your actuals. So you say you were going to have this many customers in the type A revenue. So 10 customers at $400 each is $4,000 in revenue. Well, it turns out that after the month went by, your actuals came in at 5 customers at $400, and you only generated $2,000 out of the $4,000 that you expected. So now you're short $2,000. So that means that you're either going to have to cut down expenses, or you're going to have to generate more leads over time so you can get up to that 10. Maybe there's nothing drastic you need to do now, but now you know that unless you get to 10, you can't afford XYZ in your company. So you're either going to have to invest more money or generate some cash flow any other way you can to offset that decline in revenue that wasn't expected based on your forecast. But you will also be able to adjust your forecast for next month, knowing that 5 is something achievable and 10 might be a stretch. So you might say, hey, next month I can do 7 easily because I know I can already get 5 at that price point. And then you do the same for the other 2. And I just noticed all the numbers are below, but you get the point that it could be also higher. It could be you got 400 people at the type C revenue and overshot that goal. And you're making up for some of the lost revenue in the other areas. And now you're like, oh, is my type C revenue better? And should I put more effort on that because I'm generating more sales easily because of the price point being lower? So now you start asking those questions that are really going to help guide the direction of the company and where you think you can drive some of the sales from. And again, you won't know that unless you measure against your forecast. And that's why going through this process at least once a month is going to be important for you to be able to manage your company to that sales and profitability goal you have set. Now, the other thing I like to kind of revisit after I've done my sales goal is my operating expense. And we saw those ratios where we said operating expense as a percent of revenue. And that is because when you have scenarios like your actuals fell below your forecast, now your spending envelope or your spending profile should also be smaller. And if you don't have a plan to change that longer term, then you might need to start thinking about cutting costs in the shorter term. Now, I'm not saying that from a month to month perspective, you need to fire half of your team because you're like, oh my God, we didn't make the sales we expected. Sometimes it takes time. If you have a path where you're like, I will double my revenue in the next 3 to 6 months, and I need to keep this staff in order to achieve that, as long as you have a plan in place for that, then it should be okay. It's when things start to continue to be a problem and you continue to make excuses as to why you're not achieving your revenue goals, where you really might want to go reevaluate your expenses that help you achieve those. And so we do the same exercise here, just in detail by month. What does it take to generate that much revenue? So then it's in concurrence with the goal expectation on the sales side. And it's kind of your checkpoint to make sure that you're not overshooting on the expense side to then kill your profit margin at the end of the day. And that's where I think those percentages are really going to come in handy, because as revenue growth, you can spend more money. And I don't recall if, so this is just another way to kind of track inputs as you're modeling things out. This is more from a SaaS perspective, or for an app that you might be trying to sell. So I like to include this example, just another way on how you would capture some of those variables as you're modeling out your financials. Maybe there is some capital involved that you have investors come in at, and so you want to make sure you model for that as well to accelerate growth over time. And you keep track of some key metrics along the way. And this, again, is applicable to other types of businesses as well. So not just software, but also services and others that are looking to track performance over time and do better forecasting. So I'm going to go back to this example here and see if there's any questions or anything you guys want me to expand on.
So I guess I'm wondering what goes into getting to the numbers that you have in the 2021 forecast and the 2022 forecast. You've got some historical data there that can help, but what calculations do you make to say this is what we think that we can achieve?
Yeah, so I use growth rates for that because it is so far out. It's a lot harder to really get into that level of detail that you would for the current year. So right now, if you're planning for 21, you might still have some notion based on 2020 what 21 might be. And so you would want to go through the detail level. But if you don't, and you're just trying to expect a certain growth rate, especially as you go into 2022, then you would set that rate up and then grow it based on your baseline from 2020 so that you know what that number would be. And that's your starting point. Then you still have to break it down by revenue stream and figure out, is that even achievable? And if so, what are the costs that are going to help drive that level of sales for the company? What does it take essentially for us to perform at that level? And it's not necessarily, if it's a 15% year-over-year growth in revenue, doesn't necessarily mean it's 15% year-over-year growth on expenses. Maybe it's double the expenses to get to that, and then over time that levels out. Or maybe it's with the team I currently have, I can generate 15% year-over-year growth and be okay. And that's how you would inform your outer year forecast. That's more than just a year out because you don't have a ton of information. And that's how I've modeled this out. It's just the year-over-year growth on both the expense and the revenue side with a profitability profile that I want to target. Does that answer your question, Michelle?
I think that it does. I mean, I'm trying to glean something out of this, having no historical data available to me. So, I don't think that that's necessarily anything that you or anyone else can help me with. It's, if you try to put a percentage growth, and that percentage is static, then you end up with an exponential growth curve, which doesn't make any sense. We don't expect to, have a graph like a hockey stick. And so then I started trying to sort of meta percentage on the percentage to try to get, and I'm making stuff up. And I find that if I change one number, then my percentages will vastly just, go from one end down to total bankruptcy and beyond if I change one. So that's why I know that I don't have an accurate model, and I'm wondering if there is any kind of a model that people use to try to figure out, okay, if you're doing this in this month, then here's a realistic expectation if you're this kind of a company with, these inputs.
Yeah, so in your case, just kind of high level, the way I would approach it would be, do you have any benchmark data from companies that are similar to yours that are publicly traded where you could see a 10K P&L statement and get some of those ratios off of them and say, how viable are those percentages for me to achieve? And then you can apply that as your year one scenario, and then maybe get some data from other startups, if available, right, that they're willing to share about their growth path. And then at the end of the day, you're going to have to set targets based on what you think you can achieve and what you know today. You're not going to know everything you need to model right now, perfectly everything, but you need to start somewhere. So what you do know, you should write down and start informing your model based on that. And then what you're going to do is you're going to probably revisit your model more often than not, just because there's so much uncertainty and so much you don't know about your company yet that you're going to need to continuously refresh that as you learn more about what you're doing and what the industry, information that might come in handy that you can benchmark against is, so that you can generate a comprehensive model. So it's not going to happen right away, but you can start with some of the basics and the structure that I show you to get, a percentage. And sometimes it's, with some clients, when I'm doing this 5 years out, I show them, a year-over-year growth rate of, let's say, 10%. And they're like, there is no way I can get to 5 million in 3 years. And so then we have a conversation about it. I'm like, what about it? Why can you? What does it take? Can you even think about that metric? And they're like, no, it's more like half of that. Okay, great. Now we just adjusted our realistic percentages to be $2.5 million instead of $5 million, let's say, right, in 3 years. And then we say that that's maybe a 2% growth instead. And so it's a little bit of that as well, that you'll need to do some changing around to see what sticks and what you think is still reasonable. And then again, it might still be off, but it's a starting point, right? And then you'll adjust from there.
That's actually really helpful. That's an interesting idea to come at it from the other end and kind of say, okay, what is your hope here? And then dial it back based on what you actually think that you can accomplish. That's very helpful. Also, I'm wondering for your this spreadsheet is for a wine and beer company. I'm actually kind of surprised that with COVID, you didn't overperform your expectations.
Right? I actually created this one before COVID hit, and then I just made a comment on like, COVID happens. So just to set an example of like what can totally derail your forecast that you would not ever think about planning for. But yes, you're right. It should be like doubling every year. But yeah, that would be my thought. Sometimes what I'll do, not to trick my clients, but sometimes I'll just try to see if I can get a gut reaction from them, and a reaction in general. I'll just be like, what about 10 million? And they'll be like, oh, no way. Or they're like, that's way too small. Like, let's try higher. And we're like, whoa, okay, so that's like this much growth. Now we need to think about the top end. So I don't even know what the top end is. I was just testing for what is their reaction to that number. And then that informs a lot about the forecast longer term on what can be accomplished, or even if, what are the expectations of growth? I mean, they might just want to stay flat. I don't know. They might be happy with the business they have today. So it's just kind of think about that and then just throw some numbers out and see how you react to those and what could be possible. Okay.
That's great. That's really helpful. Thanks.
Yeah, no problem. And it's really hard to forecast with so much uncertainty, but that's really what forecasting is. So you just get better at it and more comfortable with it as you try it more and more. So that's really the goal, is for you guys to practice it and again revisit it. And I'll talk about this part of it, which is the coming back to it and revisiting the forecast, because I think that that one is also important for us to think about. Hopefully you guys can see my screen again. And let me move on to the next one. Okay, so we talked a little bit about this, but I just want to kind of reiterate, how do you refresh your model to make sure you stay current and making sure that you have the relevant information to make decisions. And again, even when I'm forecasting for clients who are paying me that are making decisions to the future, I always tell them there's a certain level of uncertainty we can't plan for, but we're going to try our best to be realistic as we go through it. So we talked about our models utilizing formulas and making sure that we can easily adjust them. So those are super key as you're building out the forecast. And then as you get more data, especially like Michelle was just saying, right, there's a lot of uncertainty, we really don't know. But as you get more data that is relevant and in a timely manner, you want to go feed that into the model, because it'll make it more robust and comprehensive. It'll really help you plan better, and it'll also be reflective of the current state of the company. And you can save, by the way, your old models to see what you said before. If you're changing things and you're like, I don't know what I started with, and what was that I said at the beginning a year ago, a quarter ago even, you want to save a revision of that so you can come revisit it anytime, and then utilize a live version that you are continuously editing if you want to just have that as a stake on the ground on where you started. But it is important that you come back to it with relevant and timely information from time to time. And I'm not going to dictate what that is to you, because you will know what is relevant that's going to move the needle in your company and help you make better financial decisions. And then we talked about asking the questions. It doesn't end at just modeling once and then forgetting about it. You want to continue to ask those questions, because you're going to get more of that data, and then more questions are going to pop up. And it's important that as you're getting those questions answered, you're also reflecting that in your model and making sure that you're adjusting things as you get more of those questions answered. And the questions will never end, trust me. When you think your model looks perfect and it's ready to go, something happens. And I'm not talking about COVID, I'm just talking about in general. A revenue stream might fall off the cliff, a revenue stream might double, your expenses might double, and you're like, what happened here? So that's why the questions and asking and revisiting your results are going to be crucial. And then we talked about just keeping it easy. The model is not intended to be so detailed and so convoluted that you can't explain it. If you have a model that you yourself made and you can't explain it to anyone, I think you're going a little too far, and you need to pull back to maybe a higher level where it's more simplistic. And don't discard the power of a simple model, because it's still going to guide your path longer term. And then if you want to make it more complex, you can, that's fine. Just make sure you can still understand how the inputs and variables behave, because that's really what's going to give you the leverage to control the business decision making, which is what the financial forecast is supposed to do for your business. It's going to help you guide and direct the path for the financial results that you're trying to accomplish in your company. Okay, and I think that is my last slide, except for questions. If there's any more questions, I'd love to answer those. Hopefully you found this helpful. And I wrote down some notes. I'm just going to review them really quick from your interest to make sure there's nothing that pops up that I might want to bring up while you ask any other relevant questions. Okay, it's two things that popped into my mind. So there is software company revenue forecasting. Oh, that one is a biggie and it can get really complicated. So here's a few tips for you, Alicia and Michelle, since I think we don't have Allison. So you want to consider amount of recurring revenue you have in your business. So that would be how much revenue you're deferring month to month. If you're not tracking that already, you should be. So create a deferred revenue schedule that's monthly. You're gonna want to know what your churn rate is. So how many clients are you losing? Maybe you have them in a 1 year commitment, maybe they're month to month, maybe they're a 2 year. You need to understand when are clients terminating their agreements and how often, so that you can apply that churn or loss client ratio to your forecast. And then you also want to add to that your new business expected with the comprehensive deferred schedule for software revenue. Meaning if you sign someone today for $100, maybe you won't see the whole $100 right now because you're charging them $20 a month. So just keep that in mind as you're building out your deferred schedule for the new sales, not just existing clients. So you have to track two separately. The deals you already closed that are going to continue to generate revenue over time. You're going to layer on top of that the new sales with the monthly revenue for that. And then you're going to subtract your churn rate, which is your lost clientele along the way. And that might just be a percentage monthly that tends to be the case for software revenue forecasting. And then when it comes to the ranges that we talked about, I want you to think about adding to those ranges a level of probability. And this is a little bit more advanced forecasting or modeling, but I think it's important to even just ask yourself the question, if you modeled out $100 of revenue per day, you're like, what is the likelihood that that will happen? How many times a month will I see that come to fruition? And you say, well, it's about 80%. So then your likely scenario is going to be on the average of $80 a day rather than 100, because you're applying that probability to that modeling. And so it's just to kind of think about the extra layer of checking to see if your forecasting is realistic. And you can just ask a question like, what's the probability? And if it's not you given the inputs, if it's an employee or someone you work with, if you ask that question, it really makes them think and reflect how realistic or likely is that number to come true. And it makes them think about all the things that need to happen in order for that to be realistic. And so when you're thinking about ranges, having that probability is really going to come in handy as well. And then let's see. I think that was on the consulting side. I had something for Allison, but I don't think she's with us. Coupon savings. So Michelle, in your case, your value proposition is really around time savings. So there should be a really strong case for the price relative to time savings that you want to make sure is comprehensive in your offering of that software to professionals piece of it, because I know that's the more challenging side of your business most likely. And then the value proposition for a manager to want to pay that from a company's perspective to invest in saving time for a professional to compile their software or compile their code faster. And maybe you already do this, but I just thought I mentioned it since I was looking at my notes.
Yeah, no, that's definitely part of how we're measuring that and delivering, like 25x value. So the value proposition is fortunately really easy for us. And yet we're still struggling with how to price this because we have really high COGS, much higher than most SaaSes do, because we have a lot of compute power and that costs a lot. So we're still struggling very much on that. And I would love to hear any recommendations that you have on how we can narrow down that pricing.
Yeah, absolutely. We could definitely chat offline if you like to do a quick follow-up. I'm sure I can come up with some ideas to share on that aspect since I do work in corporate. I have some thoughts about time savings and calculating maybe that impact, you know, and turn around and then deriving that to a price point that is less painful for someone to want to sign up. Well,
That would be great.
of course. Awesome. Okay, so I think I just have a few minutes, so I'll leave you here my information. Feel free to reach out if you have any questions. I'm sure Carrie can also put you in contact with me. I have a website, so feel free to book some time there if you want to chat after this. I'm happy to help. And I hope you found the content helpful. We'll make sure we make those available to you. I'll send Carrie a copy. She can distribute as she normally does.
So, but I was going to share our upcoming events really quickly.
Yeah, I'll let you drive.
Okay, great. So, okay, does everybody see the upcoming events? Okay, a couple things I want to point out. Pitch Oregon going on, well, we actually have Pitch Club going on next week. I forgot to put that on here. I guess it's because it's not technically a women's only event. But we have Pitch Club coming up next week on the 17th. If you'd like to practice your pitch, please go to our website and you can register there, but it's a really great place to get feedback from your peers, and there's some angel investors always in the room. It is virtual, but it's a fun evening. December 1st, we have our annual pitch competition. Fox Face Systems, Alicia is one of the finalists, so she will be there presenting. And they are competing for a service package and a cash prize of $2,500. And then we have another functional workshop just like this one, but we're going to be talking about team building. And we've got another amazing entrepreneur, Robin Jones, coming in, who's going to talk about just some of the more unique ways of going about finding candidates that really fit in with your culture that might not be mainstream. So I would recommend everybody that's here tune into that. She's got some really innovative stuff that she's been doing with the company that she's currently working with called Monsoon. And then January 13th and 14th, we've got the TiE Global's Women's Pitch Competition that's actually taking place in Dubai. And I don't know if you guys know, but we've got a great women-owned business named Yo Massage in the area who will be competing for $100,000 in Dubai. They're actually going there. Even aside of COVID and all that, they're going to go there. So we're excited to be helping them get prepared to shine big for Oregon. And then our full 2021 calendar is still TBD. But if you have any ideas on, content that would be really helpful, I'm even starting to think maybe we should do just maybe some sort of, maybe some sort of virtual networking event. Just because, Alicia, when you were just kind of talking real, just when we first got on, I think we're all kind of missing that, So anyways, if you have any ideas for what you'd like to see for our women's calendar next year, just shoot me a line. And again, thank you to our sponsors. And thank you so much, Carla, for your time today. And thank you, everybody who joined.
Thanks, Carrie.
Thank you, Carla.
Bye-bye.
Nice to meet you guys.
See you later.
Thank you so much.
Thanks.
Bye, everybody.
Bye.